What's going on, everybody? Welcome to another episode of The Remote Real Estate Investor. I'm Michael Albaum, and today with me, I have a very special guest, Andrew Davis, who is the Director of Investor Relations at PassiveInvesting.com. And today, Andrew's going to be talking to us today about what you need to be aware of if you are going to participate in a passive investment, what passive investments even are, and some red flags to be aware of if you're going to be jumping on board one of these. So let's get into it. Andrew Davis, what's going on, man? Thanks so much for taking the time to hang out with me today. I really appreciate you coming on.
Michael, it is my pleasure. Thanks so much for having me.
No. It's my pleasure. So you're based on the East Coast, right?
That's correct. I'm in Asheville, North Carolina, not to be confused with Nashville, Tennessee. So you have to enunciate the ash.
I could see that being a very common misconception.
Yeah, you really gotta lean into that A.
So give us a quick backstory on kind of who you are, where you come from, and how you got involved in the passive investing space.
Yeah, absolutely. So, I am Andrew Davis. I'm the Director of Investor Relations for PassiveInvesting.com, and we are a private equity, commercial real estate investment group. And so what we do effectively is we buy large institutional quality multifamily and self-storage assets. And all that means is you really kind of three factors: the market, the deal size, and the class of the investment. And so $30 to $100+ million purchase price is kind of our typical acquisition size. We're wrapping up our biggest deal to date in the Fort Myers market. That's a $109 million, 300+ unit deal. Markets,
exciting.
Yeah, big. What the managing partners call a big boy deal. And and
I love it.
And then it's we play in just kind of higher quality asset classes, and we'll probably dig into that a little bit more. So it's what's called the suburban class A asset. We also buy B class assets, and then the markets that we play in are primarily the Sun Belt markets. So those are North and South Carolina, Georgia, Florida, Texas, and Arizona. And then we're also looking in Denver, Colorado, and Boise, Idaho as well. And so that's just kind of high level. Our strategy and how I landed here is, started out in the single family space, like many of your listeners have or are. And man, it's a tremendous place to start. A lot of wealth can be created there, and there's tons of opportunities there, and it's a great place to cut your teeth. And that's how I started. And so I'm very much a learn by doing guy. And so I was kind of in a transition career wise. I grew up on the West Coast. When my wife and I met, she was in Florida, and she had just started a business. So it was like, who's going to move? And I said, I'll move. I'll have an adventure. So I moved to Orlando, Florida, quit my job, sold my house. I had bought in the Portland market at a very good time. So I was sitting on some capital. I had some flexibility, and I was just kind of floundering. And my wife, I think, 6 months into being married, was getting pretty tired of me kind of, woe is me. And she's like, well, you never shut up about real estate investing, so maybe you should do something with that. And
you look up from your Halo game, like, all right, fine.
Okay, fine. All right. But it was funny. It was like this light bulb moment for me. And I was like, you're right. I love this stuff. And so I just dove in, and I started going to, local REIA meetups, and just anybody that I knew had anything to do with real estate, taking them out to lunch or coffee or whatever. Tons of time on BiggerPockets, reading every book I could get my hand on, and really just got a basic idea for how to flip a house and kind of how to evaluate a rental, right? Just basic underwriting. Didn't really know what I was doing, but I knew enough to be dangerous. And so, and then in kind of reading and learning about that, I realized that, people, and going to these different meetups and things like, there's people with capital and there's people with deals, and these people partner up and they get stuff done. And I'm like, I can probably talk somebody to get into giving me money to flip a house. And so I found a house to flip. It was a foreclosure, $87,000, which is silly to think that you could buy that in today's market, and put together a little deck and found a contractor to partner with me to do the rehab, and he was going to pay for it. We were going to split the profits, and then found an investor literally on BiggerPockets to come in and fund the acquisition. And that was my first deal, and which is amazing in retrospect because I had no experience, right? And
right.
I mean, I was just new enough to be dangerous, and so long story short, we broke even on that deal. The contractor was not great, and didn't do a good job on the reno, but thankfully we broke even. Isabel and my wife, broke even. I was able to pay the investor. He made like a 17% return, but it really, what that did for me is it really kind of, it opened me up to the power of real estate investing, right? And the power of not being limited by my own capital, of knowing that, hey, if I can provide value in these areas, then other people can provide quite literal value in other areas, and there could be partnerships formed, and I can grow a lot faster that way. And so I built a little business, just buying single family homes, duplexes, doing a mix of flips and buy and hold rentals, and got up to a point over several years where I had 16 units, and that was good.
Nice.
But I just would get to the end of every single one of these deals, and it's a lot of work to put them together, a lot of work to renovate them, a lot of work to manage them and deal with tenant issues and all the things that go along with single family investing. And it was like, man, this is just the risk and the effort, the reward for the risk and the effort just does not feel commensurate to me. And as I was in this space, and I was very fortunate to just connect with some really sharp operators in the commercial, in the multifamily, mobile home park, self-storage, just people that were buying these larger assets. And every single one of them would tell me, hey, it's the same amount of work, but the reward is exponentially higher. And so that really just continued. I really, really kept looking for ways to get into that space and connecting with different operators. And I also knew, hey, I'm really strong over here, right? I'm good on the capital raising side. I'm good with people. I'm good at building relationships. But operationally, details like that kind of stuff, that's not my forte. So I really knew that I needed to have a partnership. I knew that I had value and a skill set to bring, and then there was also a lot that I needed, right, to kind of operate in my zone, my circle of competence, as Warren Buffett would call it. And so, long story short, this investor relations role opened up at passiveinvesting.com. And I had been following these guys for a while and thought very, very highly of them and what they were doing in the space, and just heard a lot of really good things about them. And so I just jumped on it and, hard pitched myself and prepped like crazy for the interview. I mean, just, got to know them inside and out, and was very fortunate to be awarded the role. And we just had a lot of growth as a group. And so in 2021, we raised roughly $197 million from passive investors. So individual retail investors. And, our typical investor is somebody who is oftentimes a tired landlord, right? And they're bought in on the principles and the fundamentals of real estate, but they're tired of dealing with tenants and toilets. And so in the course of that time period, I did the math the other day. I had 1,700 investor phone calls in 2021. So I had the privilege to talk to a lot of people and move from kind of an individual contributor role into a director role. And I was just recently able to bring on 2 additional investor relations guys to just support me in onboarding new passive investors into our network, and just informing them, answering their questions, just letting them know kind of the mission and the strategy. And so that is sort of the meandering way I got to be where I am.
Oh, that's so awesome. So Andrew, I'm curious, was your thesis correct or accurate in that so many of your investors of the 1,700 are folks that are just tired landlords? They just don't want to do the direct ownership thing anymore?
Yeah, I say that is probably, I would say it's approaching 50%, and that's anecdotal. So I would say that our investors are a mix of every single one of our investors is bought in on the idea of real estate, right? And it's a mix of like highly paid professionals, so lawyers, doctors, engineers, executives that want to diversify their portfolio, want to have an allocation of their portfolio in real estate, but quite literally don't have the time to go out and to buy single family homes and renovate them and manage them, or manage the managers. And then yes, a large chunk of them are folks who have acquired. We have one investor in the Atlanta market, and he was a builder, and over his career, he built tons of homes, but for himself, he built 65 single family rentals. And he and his wife did very well as a builder, obviously did very well in building up a rental portfolio for himself, but they're in their 60s. Their kids are grown. They want to travel. They don't want to be managing 65 single family homes. And so he just very strategically liquidated those and rolled those in a very tax conscious way into our passive investment. So I would say it's a good chunk of people that want all those benefits, but just don't want to have to worry about it.
Okay. And if someone listening to that is like raising their hand, like, yes, me, I fit the bill, I fit the category. I also don't want to do the direct ownership thing, but once the exposure is bought into real estate, why wouldn't someone just go buy a REIT? I mean, what's the difference between like this type of passive investment or a REIT or something that's traded on the open market?
Yeah, man, that is a tremendous question. So you've got a couple distinctions
Yes, that's my one for the
versus
episode.
so you've got a couple distinctions between a publicly traded REIT or real estate investment trust and investing passively in a syndication or in a sponsored real estate deal. And so I think REITs have their merits. However, oftentimes what you see in REITs is one, you don't really have direct ownership. And so one of the things that people really like about investing with us is when you invest in a deal with us or somebody else that's using the structure that we use, this 506B or this 506C structure, you are becoming what's called an LP or a limited partner. And so what that means is you participate in all the benefits of direct ownership without any of the liability or the management responsibilities or the operational responsibilities. So you still get monthly cash flows. You still get capital appreciation. So say on a $50,000 or $100,000 investment over a 5-year time horizon, you could potentially see a 2x of that invested capital in addition to your monthly distributions. And then the third benefit that really that's really appealing to a lot of people is the pass-through depreciation. And so every single one of these assets that we acquire, and if the sponsor's competent, they'll be executing this strategy as well, is they do a cost segregation study. And basically what that does is it takes the depreciable life of the asset, which 27.5 years, I believe, for real estate, and it fast forwards the majority of that depreciation benefit into the first year. And then as an equity owner or a limited partner in that deal, alongside us, the general partner who's operating the deal, you get that depreciation passed through to you. And so you can use that to offset any passive, income that you receive. And I'm not a tax professional, please consult your tax professional. This is not tax advice, but it effectively becomes tax-free income. So that's you get the control. And I think when you invest in a REIT, what a lot of people like about investing in real estate is the control of your capital and the different things that you can do with a REIT. You kind of forego those benefits. You're invested in the asset class, but you're not getting a lot of the benefits of being invested in real estate.
Okay. But you might get some of that liquidity flexibility, so to speak, as I can buy a share today, sell it tomorrow. That's going to be very different with a, would you call it a direct investment in a syndication?
Yeah, absolutely. So that's the trade-off, is the liquidity piece. And so what we tell investors is, hey, we were underwriting these projects for a 5-year hold. We've exited 6 deals so far to date as a group. That's called having a full cycle deal, meaning you buy it, you execute the business plan, and you sell it. Every single one of those exits has been in 3 years or less, but that's never a guarantee. So yeah, your money is going to be locked up for a time period, and of course you'll be receiving distributions on that during that time period. But yeah, you have to be bought in for the short to mid term. Okay,
and you mentioned that there's no liability with regard to being a limited partner or an LP. So I just want to highlight that for folks. So if I invest, or if someone invests through a passive investment, through a syndication, I can't get sued as an owner if there's a big lawsuit.
That's exactly right. So as a limited partner, you have no exposure to lawsuits. You have no exposure to any debt issues if for some reason the sponsor was to be foreclosed on. So you're completely insulated from those things. Now, of course, all investments carry a measure of risk, and that, I mean, it has risk just like any other investment does. But from a liability perspective versus active ownership in a single family asset, where if your tenant takes a fall or doesn't like you or something like that, they can sue you. You're completely insulated from that type of liability.
That's great. Whenever I hear that type of thing, I think about, have you ever seen Arrested Development?
Of course.
And then when he says, there's these limited liability companies, but we should start a no liability company. The Bob Loblaw, the attorney, is so good.
Bob Loblaw's law blog.
Yeah, that's it. So this is literally that. It's perfect. It's a no liability company. I love it.
That's right.
I love it.
Our attorneys are slightly more competent than Bob Loblaw.
Right. One would hope. So, Andrew, talk to me about returns, because I think a lot of investors, especially in the direct ownership space, and even maybe in the REIT space, can look and say, okay, stock market does about 7 to 8% roughly. I know what my cash on cash return could be like in a direct ownership model, and I understand what the appreciation potential might be. I know you said, potentially maybe 2x on your money. talk to us a little bit about what those might look like in some of your investments or a typical syndication investment.
You bet. So I'll give you kind of our typical returns profile, and I think then I'll highlight one really important distinction in comparing a direct, single family ownership with investment in syndication. So typical returns profile, basically what you have is you have what's called the preferred return, which is what you receive during the hold period. Some sponsors pay semi-annual distributions, some pay quarterly distributions, we pay monthly distributions. We feel that's really, really important because it's a way of ongoing communication about the performance of the asset. So every month our investors get a monthly update, they get a monthly distribution, and then we also share the financials for every asset they're invested with us in quarterly, so they can see exactly how that asset's performing, so they get exposure to the performance of the asset. So our typical returns in terms of cash flows during the hold period are going to be anywhere from 7 to 9%. So that's what we target. And then that's just what those monthly distributions would be, right? So say $100,000 investment, 9%, 9,000 divided by 12, you're getting $750 a month.
That was really
in
good
addition
math.
to that.
That was so fast.
Yeah, well, as you might imagine, I may have used that example once or twice before.
Once or twice, yeah.
I'm no savant. You can ask me another math question and I'll bust out my calculator. And then you've got the upside, right? And so every single asset that we acquire, right, we're buying it at a good basis, and then we're executing a value add strategy on that asset. In some cases, that's purely operational, where we're just buying it where the current operator, or in many cases, the developer, has just, for whatever reason, leased the units up way under market rent, have not optimized expenses, have not taken advantage of opportunities in the marketplace to maximize the revenues for that property. So oftentimes, just by coming in, acquiring an asset at a good price and operating it well, we can achieve dramatic increases in value. And one of the distinctions about investing in a multifamily asset with us or with another sponsor versus investing as a single family asset is the values of commercial assets and multifamily assets are not determined by comps. They're determined by what's called the net operating income and the cap rate. And so we can with a great deal of certainty, know that for every dollar that we increase the income in that property, that's going to translate to an increase in value and an increase of exit price. And so when we're doing our calculations, say we buy an asset at $88 million, that we can look 5 years down the road and say, hey, we're going to increase the net operating income of this asset by $1.5 million or $2 million over the hold period. And then when we go to sell that asset based on the cap rate, we know that we'll be able to sell it for $130 million. And then obviously the difference between those two things is the profits. And then we get to distribute those profits to our limited partners. And so you've got the cash flows during the hold period. You have the opportunity to take your initial investment and see really significant returns. So what we target on the very, very low end is around a 15% internal rate of return, which is just another metric for annualized returns. And on the high end, 20% plus. And on the deals that we have gone full cycle on, the 6 deals that we have acquired, taken through their business plan and sold, we have averaged a net return to our investors of 27%. So very, very strong returns there. And then not to mention the depreciation. So much of that income, as long as you have a competent CPA, much of that income is tax-free. So I think the one important distinction to highlight there is when you are comparing the returns on a single family asset, and I get this question a lot. Well, I can go out and get 15% cash on cash returns and buying a single family or a duplex. Why would I not just do that? Well, what you get in investing in multifamily real estate is scale. And I experienced this firsthand multiple times where I underwrote a deal. The cash on cash returns were fantastic. They were like 30%. But then guess what? I had one tenant that quit paying rent. I had one tenant that beat the place up, and I'm at 3 months with no income. So you've got pro forma, and then you've got reality. Whereas in a multifamily asset, when you've got 300 plus units, we underwrite these deals. So 10, 15, 20% of the tenants could move out, which in the markets that we're investing in and the quality of assets that we're buying is historically unprecedented. We would still be able to maintain distributions, maintain the integrity of the asset, and execute a strategy to turn that around and bring that occupancy and that value back up. So I think that's a really important distinction. It's not an apples to apples comparison because with the scale and the size of multifamily assets, you get that protection.
Yep. That makes so much sense. Mm-hmm. I mean, and I think one other distinction that's important to make too is that a single operator, an individual operator owning direct ownership, single family homes, multifamily, whatever it is, You could be really good at that, but there are like companies like yours and others that are dedicated to that have teams of professionals dedicated to making sure the thing goes well. And so we can be a lone wolf or be part of a wolf pack.
That's right. Hey, excellent. Excellent analogy.
Thank you. That one was on the fly too. I got to give myself props for that.
Perfect. Really solid.
That's awesome. Andrew, you said something that I kind of want to come back to, and you said you execute your value add strategy and you know what you're able to increase the net operating income by, and you're pretty confident around what your exit cap rate is going to be. How do you determine that? I mean, so many people are seeing cap rates change, and right now we're seeing them compress, but people are talking about interest rates changing, so maybe they're going to expand. How do you forecast cap rates so far in advance?
Yeah. No, that's a very, very good question. And so one of the things that we do is you'll see a lot of operators give a very, very specific set of returns. Like this is going to be a 27% IRR with a 2.5x equity multiple. And my question is always, well, how do you know that? Because you don't know what interest rates are going to do, and you don't know what cap rates are going to do, and you don't know how market's going to perform. So what we do when we underwrite a deal and when we put together offering memorandums for our investors and walk them through the returns is what you'll see is a range of cap rates. And so we have best case scenario and kind of a worst case scenario. And part of the reason that we play in the space that we play in terms of both the geographies that we purchase in, as well as the asset types that we buy, is historically they have had far less cap rate fluctuation in a down economic cycle, right? So I was just chatting with somebody yesterday, and it was like, man, the equities markets and interest rates are rising, and people are starting to get a little skittish. And I don't know what's going to happen. Nobody knows what's going to happen. But what we've seen is that because we're investing in markets with strong fundamentals, with double the national average in population growth, with a diversified base of strong employers, with favorable supply-demand ratios, right? We're in markets that are undersupplied for this type of product. What we see is those markets have the fundamentals to weather these storms better than like a tertiary market that's very dependent on one industry or one employer, or it's heavily dependent on, say, tourism. And then also because we invest in these higher quality assets, we have just a more income stable tenant base. So this year, the average household income of the lessees in the assets that we acquired was well over $90,000 a year. And so what that tells us is, which is crazy, right? Like, you'd think they'd be buying houses, but the single family housing market is crazy. So a lot of people are just opting to continue to rent. And so what that tells us, right, and what that tells the market is that these assets are more stable because you have more stable income. And so when you look at cap rates and you see how cap rates fluctuate across different asset classes, and the higher quality assets, you might, in a down economic cycle, you might see a little bit of an up wave, right? Cap rate expansion and then back down to a compression. Whereas in maybe C and D class assets, you're going to see 300, 400 basis point cap rate expansion. And all that means is those assets lose significantly more value and take longer to recover. And so the reason that we're in the space that we're in, it's a more conservative space, but it also is more risk adjusted for those events that happen, right? These cyclical economic events. And so do we know what's going to happen? No, but we have really good historical data, and we're buying strong assets in good markets.
Yeah, that makes total sense. Going back to something you also said earlier about investing via a tax responsible or tax conscious way via passive investments. I mean, how can people invest in these passive investments? Can they 1031 out of direct ownership and take the proceeds and put them into passive? I mean, what does that look like?
Yeah. Excellent question. So yes, and so you can 1031 into a passive investment. Most sponsors are going to have a minimum. The reason for that is when you were 1031ing out of direct ownership into a syndication structure like ours, the structure becomes a little bit more complicated. You end up setting up a tenant in common structure, and got all kinds of diagrams and explanations of this, but long story short, it becomes a bit more complex. And so our group, which is actually one of the more kind of favorable minimums, generally we're looking for a minimum of $1 million being exchanged in order to accommodate a 1031 exchange. But you've got other options. Okay. There's things like deferred sales trusts and Delaware statutory trusts, but then you can also do what's called a lazy man's 1031 exchange, where really the whole see, put this on the episode highlights, right? So
that's right.
So what that is, right, is the reason people are wanting to execute a 1031 exchange is they don't want to pay capital gains taxes. So if you invest your gains and your proceeds from that sale strategically in investments that have high degrees or high amounts of depreciation, like opportunity zone funds, or just strong assets that the operator is going to do a cost segregation study, is going to do some value add that you can write off, then you can get enough depreciation to largely offset or completely offset those gains without the constraint of the 1031. Because the 1031 is a beautiful thing, but there's also a lot of constraints around it. You've got your 45-day identification window. You've got 180 days to close. I've got a call in like an hour, like 2 hours with an investment group whose identification window ends on 129. And they're like, we need something to identify, and we just don't have anything that we're closing on that's I think is going to fit their time frame, unfortunately. So there's ways to mitigate or completely avoid those taxes without I think 1031 is amazing, but you have options outside of that if you want to reduce those capital gains taxes.
Interesting. I'd never heard about the lazy man's 1031, and that's such a good point. Like if you have the gains, or excuse me, the losses to offset the income or the gains, yep, you might not need to make yourself crazy.
That's right.
Super good point. Mm-hmm. Andrew, tell us, how should we be evaluating operators or sponsors? I mean, what should be on someone's BS detector? What should throw up red flags when looking at potential deals or potential sponsors?
Yeah. So excellent question. I'd be happy to share a piece of content with the listeners. We actually have a red flags doc that we've prepared for investors to look out for. And the reason behind that is Dan, one of our managing partners, before he ever became an active operator, he was passively invested very, very heavily. So I think right now he's in 50 different sponsored real estate deals with like 16 or 17 different operators. I mean, wow, very heavily invested, right? And so, of course, developed some criteria about who he would and wouldn't invest with and why. And we've just kind of turned that into a doc that investors can add to their due diligence process as they're evaluating different deals and sponsors. But I think a couple high level things or some principles for folks that are looking to get into this. Number one, the operator or the who you're investing with is as important, if not more important, than the what you're investing in, right? Okay. In this space, there's a lot of opportunity in this space. And right now, there's a lot of capital in the markets, both in the institutional markets as well as in the individual markets, right? Single family home, I was looking at the Case-Shiller index this morning, it just got launched. Single family home prices have gone shoot, right? There's a lot of people with a lot of equity, whether they're refinancing, whether they're selling and looking to deploy it. And so anytime there's a lot of capital moving into a space, there's a lot of people that are going to want to step in and get their slice of that. And so I think you have a lot of folks that you very well may be well-intentioned, but don't have the operational experience, don't have the time. There's a lot of folks that aren't full-time that are doing this as a side hustle or something supplemental to their day job, and don't have the track record of the experience. And so I think really when you're talking to different sponsors, I mean, anybody's list you get on, right, and set up a call with them, you can talk to somebody like me, like my team, with us or with any other sponsor, right? And really knowing who they are, why are they qualified to operate a very expensive business? And that's what these are. These are businesses that just happen to have real estate attached to them. So operational experience is very, very important. Track record is very, very important. You want to know, hey, have they ever lost money? Have they ever done a capital call where they've gone back to their investors and asked for more money because they didn't underwrite the deal well? Is their strategy dependent on a refi mid-hold in order to make it work, which is risky because you don't know where interest rates are going to go? So there's questions. There's a handful of questions like that. And like I said, I'd be happy to share them. But really, I think the key principles are who you're investing with, right? Is so important, because at the end of the day, they're the one operating that deal. And if you can have a great operator that has, a challenging deal And because they have business experience, because they have maturity and wisdom, they can turn that around. And you can have a crummy operator that gets a great deal and doesn't know how to operate it, doesn't know how to maximize the upside, doesn't know how to cap the downside, and it can perform far worse than it should. So I think that's really what I would highlight there.
Okay, that makes total sense. And are most passive investments, do you need to be an accredited investor for, or are there passive investments that people can participate in without being an accredited investor?
Yes. So totally depends. And just like a really quick kind of key educational piece, primarily what you'll see here is two different structures. You have a 506B or Bravo, and you have a 506C or a Charlie. 506Cs are for accredited investors only. And an accredited investor is, just very quickly, is somebody that makes, they're filing individually $200,000 a year, jointly with their spouse or significant other $300,000 a year, and or they have a net worth of $1 million, excluding any equity in their primary residence. So you've got to check one of those two boxes. There's a couple other nuances, like if you're a registered securities professional or if you're a key principal at a real estate firm or something like that. But those are the two primary distinctions, is the income and the net worth. So there are a lot of opportunities there for accredited investors only, but there also are a lot of operators that do open up quite a number of opportunities for non-accredited investors. So with a little due diligence and research in the space, you can find opportunities on both sides of it.
Okay, awesome. Mm-hmm. I mean, Andrew, this was so enlightening, so good and fun. Where can people reach out to you, get in touch with you if they have questions for passive investing specifically, or want to reach out to you?
TikTok.
Love it. Azusa Pacific
kidding.
Guy.
No. Yeah, I won't. And, if I do, you have permission to slap me. No, LinkedIn. That's primarily where you can find me social, like on the social channels. I'm pretty active on LinkedIn. Just Andrew Davis or passiveinvesting.com, and you'll find me. Or you can just shoot me a note, andrew@passiveinvesting.com. And if your listeners want to send me a note, and I'd be just more than happy to kick them that red flags document I mentioned that just kind of add to their due diligence checklist for vetting operators.
Amazing. Thank you so much.
Mm-hmm.
Any final words, thoughts, pieces of wisdom that folks should know about as they're considering passive investing?
I mean, I think that's a big part of it, right? So I think for a lot of folks that we talk to, they're new to the space. They like the idea of it, right? But anything when you're doing it for the first time is going to feel a little bit uncomfortable or risky. So what I always tell people, right, is make a minimum investment. Find a syndication where you can put, I don't know, 25K in, right, and see how it goes. And the beautiful thing about real estate, right, is if you need to comfort your nerves or calm your nerves, if you're investing with a good sponsor in a good market, U.S. real estate has performed very, very well since kind of the inception of the country. And so, of course, do your due diligence. Be educated on the process, on the market, on the sponsor. But I think it is a very wise place to diversify your portfolio.
Love it. Love it. Awesome, Andrew. This was so much fun. Thank you again for coming on and hanging out with me. Really appreciate you. And I'm sure we'll chat soon, man.
I hope so. Thanks so much for having me on. I really enjoyed it.
Alrighty, well, that was our episode. A big thank you to Andrew. Thanks again for coming on. We definitely look forward to having him back to do some more deep dives into some really cool things that are going on at passiveinvesting.com. As always, if you like the episode, feel free to leave us a rating or a review. They are super helpful for us. Can't overemphasize that enough. And as always, we look forward to seeing you in the next one. Happy investing.